Hi everyone, Lorne from LM Trading. I wanted today to cover a strategy called the open range break. Now, this traditionally is just the first 30 seconds of equities or whichever you're trading. It slightly differs for golds, oil, currencies. So I'm just going to bring this up to give you a rough idea. So the first 30 seconds of regular trading hours in the S&P Nasdaq is known as the opening range for the day. I've got the times here. I'm based in the UK, but this is a New York time. You're going to need to set your specific trading hours to whatever this will be on your chart, whether you're trading MT4 or TradingView, whatever it is, you need to take that into account. And this has always been noted in futures as the opening range for the day, and it was back in the day when the pips were trading, and the concept of it is if you're above the opening range, you're looking to buy, and if you're below the opening range, then you're looking to sell. Now, you're not just going to blindly do that, as you'll end up getting chopped up, as an example, but this is a great strategy as it allows you to get quickly with momentum and to have quick winners when you're right. And if you manage your risk accordingly, you will be able to take tight losses and let your winners run from there, which is the definition of good trading. So um, I have this set up on my charting software here. So I have this every day. This is NQ or the Nasdaq. I have this set up to draw the opening range in the first 30 seconds, and it does it automatically for me every day. If you don't have a software like this, you're going to need to just mark it yourself, just as market opens. Now, you can't just blindly buy this. Like you would see if you buy it up here, then your price is coming back, you're getting stopped out. So from the trading and experience that I've done with this specific strategy, you should never be buying into VWAP, for example, or volume weighted average price. So that would just be crazy. Today's a terrible example as a bank holiday. NQ and ES have literally been in like a five point range. So I mean, this is not fantastic. I was trading the FTSE this morning, and I'll show you an example after this. But the premise of this trade is price goes below here, you sell, and price goes above, you buy, typically. And then you're ultimately looking to target the next area. So if you then go 4 points in profit, you take 30% off of your position, move to break even, and then ultimately you're just going to let your winners run. So if you're on those days you're getting 20, 30 ticks, sorry, not ticks, points, you're going to have a massive winner. You'll be getting 4 or 5 to 1. Now, I traded this morning on FTSE, took like 30 points. I'll jump to this trade as an example. So I came to charts. This initially had drawn, and at the time I used market profile. So in order to me stop just randomly buying, I wanted price to break the overnight high, which I had up here, because ultimately the overnight high or overnight inventory would have acted as resistance. So my bias was to the downside this morning. So ultimately price broke here, I got long, stop was extremely tight up here, and the market just dropped the whole day. So it was a fantastic trade. Obviously, I'm not a god. I'm not holding all the way through this. So I took my 30% off here. I actually got off here because Delta started to dry out. So I get out from my other trade here. Price then come back up to VWAP and to the overnight low. And then I took another short position and covered here. So that was my trade for today. I was in and out, and I was waiting for the same to happen in ES and S&P, and the market opened in like a 4 point range, which is just there's just no point. I mean, the idea of this trade is it's meant to be in line with the algos. Now, back in the day, in the pits and the CME in Chicago, when the market makers were ultimately people, and they were buying and selling, and they were ultimately creating the market. Nowadays, that's not happening. Majority of the trading is done by HFT trading or algorithms. Now, we're never ever going to be able to, in essence, get in and out as quick as that. That's just not possible. We don't have the spreads, we don't have the liquidity, and they're in essence, their fee structure is completely different. They're doing millions and millions of trades a year, and they are ultimately going to their liquidity providers and negotiating their commissions at the start of the year, depending on the volume targets that they're going to be doing. It just doesn't work like that in retail land. That's just not how it works. So completely different playing field. So you need to approach the market with something that first off just works in the long term without statistical edge. So negative skewed risk to reward, in my opinion, it just doesn't work. Granted, you can do it, but you're going to need to have a much higher trade frequency. Um, and you're going to give away 3-4 of your winners every time you lose, which is just not great in the psyche. So this side of things allows you to be wrong quickly or extremely right, and you're normally in and out within the first couple hours of the day. To be honest, is a simple way to look at it for this type of position. Now, if anyone wants to ask more questions about this and how to factor all of this in, but you need to use confluence in your trading as well. I use market profile, as well as I've always been a trader that fades. So that's my typical strategy. Um, However, I, over the last number of years, have wanted to focus on just getting with the trend, as it's so much simpler, and you're not fighting against the market. Um, so typically, if market's out of value, I will fade back into the point of control, typically. But with these types of trades, you're in and out. It's a great, great strategy, to be honest. So if anyone has any further questions in this, just let me know, because you're going to need to make sure you've got this set up correctly and have some confidence with taking these positions. Because if you're just simply buying every time it breaks above the highs and selling below the lows here, you're going to get chopped up. So you need to have an ultimate bias, I need to use it with some confluence, for example, like delta. And delta is measuring the difference between aggressive buyers and aggressive sellers that are ultimately hitting the market. Um, it does not take into account any of the limit orders or passive orders that are hitting the market. So in order for price to break at a level, you're going to need to see some fresh delta coming in at those levels. So what I mean by that is, if price is coming down here, for example, but delta is not negative, or it's going green and positive for the day, the chances are that this could be a false breakout. You can actually see this here. So price goes up for this candle, and actually delta is negative. Also, we're breaking VWAP, and a very, very common trader trap is price breaks VWAP, people steam in long, and then it fails back below VWAP, and then we sell off. Extremely, extremely typical how this happens. So delta is a good way to help for momentum. Market profile gives you your general context and outlook for the market, and what is perceived as value for the week, or any given day. Just allows you to see where you're going to take profits, because you can't hold this trade forever. You need to decide where you're going to scale out, where you're going to cover, and where you're going to lock in some profit. So all of that you need to then factor in. If anyone would like to know the software that is being used here, or would like any tips on how to set it up, just let me know. And I would appreciate if you could subscribe and leave some comments on what your thoughts are, as I'm looking to build a trading community and start getting the ball rolling with this. So I would appreciate that. I'll see you in the next video.